Hi everyone and welcome. Today we're going to talk about something that comes around every year and causes just a little bit of panic. I am joined today by Tony and by Ryan, and we're going to have a conversation about the end of the tax year. So let's start from the beginning. Tony, what is the actual tax year?
So officially the tax year runs from the 6th to the 5th of April each year. So the tax year end is essentially that end point where we need to check that we've done everything. So it's things like how much dividends have you taken so far? Do you need to or want to take more? And also the impact of doing so. It's also a really good opportunity to plan ahead. So you think about things like what future changes are coming in and how that's going to affect things sort of in the future.
So it's really just a good time to get your ducks in a row.
Yeah, exactly, because once the 5th of April has passed, there's nothing you can do about it.
What do people ask you most at this time of the year?
So almost always at this time of year, it's can I take out more dividends? So at this stage, the answer is normally it's a possibility. However, as long as the company firstly has enough profit to do so, and also the most important aspect is whether it's actually tax efficient to do so. So in that instance, we will review and look at what income you've taken already to date, what tax band you're in, whether you're in the basic rate band or higher rate band or additional rate band, and also what impact it will have you taking those additional dividends. So if, for example, you're in the basic rate, if they push you into the high rate band, what impact that will have. We'll also need to look at whether the company can actually properly afford it from a cash flow perspective.
And of course, it's not just about all the cash that's sat in the bank account, is it?
Exactly that. So dividends can only be paid out from profits after taking into account the corporation tax that's due. So we have to allow for the corporation tax on any profits in the company. We also have to take into account any losses brought forward and also the dividends already paid to date. That then determines what's then legally left out to distribute.
What about expenses? Is there anything that anyone needs to consider with the end of the tax year?
Yeah, so most expenses are normally driven by the company year end, unless your company year end is 5th of April. So the main one really you need to think about is the trivial benefits, which is the one that's driven by the personal tax year.
And as a reminder, what are the trivial benefit allowances?
So this enables you essentially to have up to sort of 6 lots of £50 gift vouchers. So it can be anywhere of your choice, as long as it can't be exchanged for cash or it's not a cash voucher, and it's not sort of a reward for performance. So it's just a case of purchasing those vouchers from the company bank and then explaining them correctly in free agent.
A nice little treat, and it's per director as well, isn't it?
Yeah, so it's limited per director and it's up to £300. So we say 6 times 50 is the most sort of easiest way to do it.
Okay, and record keeping, is there anything that anyone needs to consider?
Yep, so record keeping is really important. You have to keep records for up to 6 years, and fines can go up to £3,000. So it's really important to keep sort of receipts for all expensive, make sure that they're sort of stored properly as well.
Yeah, I know I recommend to clients to keep them electronically because that's usually better than trying to keep the paper copies.
Yeah, exactly. So attaching things to transactions in free agent is usually the easiest way of sort of taking care of that record keeping.
Dividends always confuse people. Is it something that you can talk us through in terms of the taxes that you pay and the allowances?
Yeah, sure. So for the current 25-26 tax year, the dividend rates are 8.75% in the basic rate, 33.75% in the higher rate, and then 39.35% in the additional rate. So still more of a saving than income tax.
And the allowance this year, is it 500 still?
Yeah, so the dividend allowance is 500 this year.
And is that changing at all from the next tax year?
So next tax year, the allowances remain the same, so that's at £500. However, both the basic rate and the higher rate are increasing by 2%. So the new rates from April 26 will be 10.75% for the basic rate, 35.75% for the higher rate, and then the additional rate remains at 39.35%.
And can you put that into real numbers for people? So if you were to take a salary of the 12,570 and take dividends of the 37,700, what does that actually look like?
Of course, so that's a very common structure for limited company directors to utilise. So for the current 25 to 26 personal tax year, the salary of 12,570 utilises your personal allowance. You then take out the dividends of 37,700. Of that, £500 is tax-free. The remaining £37,200 is taxed at your basic rate band at 8.75%. This then gives you dividend tax of around £3,255 to pay. There's usually no to little national insurance payable at that salary level, so overall it's still a very tax efficient structure to pay yourself by. However, for the upcoming personal tax year, although this will remain the tax efficient strategy, with the new rates, it will still be the salary of £12,570 utilising your personal tax-free allowance. You'll still have the £500 dividend tax-free allowance, but instead the £37,200 remaining in dividends will be taxed at 10.75% as opposed to 8.75%. This will then result in a personal tax bill of around £3,999.
So about £750 more in comparison to the previous tax year.
Exactly, and that's without earning any additional income.
People also forget about payments on account, don't they?
They do, yeah, and they can be quite a nasty surprise. So essentially, if your tax bill is over £1,000 and less than 20% of your income is taxed at source, you're asked to pay payments on account. So essentially, you pay 50% of next year's tax bill in January, and then you pay another 50% in July. So effectively, you're paying for this year and next year at the same time.
Okay, so let's move away from tax on income and think a little bit about savings. So what about ISAs and pensions?
So when it comes to ISAs, the ISA allowance is £20,000 per person per personal tax year, and any growth or interest inside an ISA is tax-free, but it is a use it or lose it allowance, so you're not able to carry it forward to utilise in future years. Junior ISAs are also available, and they have an allowance of £9,000 per personal tax year. Then when it comes to pensions, there are two main routes that you can utilise. So you've got the employer pensions contribution route from the company, or personally paid pension contributions. Often, when viewing it from a limited company perspective, employer pension contributions directly from the limited company are more tax efficient. Firstly, because they reduce your corporation tax bill, they don't attract any national insurance, and also they're not treated as personal income when reviewing your income for the year. Per personal tax year, you have an annual allowance to utilise of up to £60,000. That is a combination of any private pension contributions you make and also any that you make directly through the limited company. So it's important that you review all pension contributions to make sure you don't exceed the annual allowance.
You also get your 3-year carryback allowances as well?
That's correct. So as long as you have been a registered member of a pension scheme, any unused pension allowances can be carried forward by up to 3 years.
Is there anything else that people should have on their radar as the end of tax year approaches?
Yeah, and this is where sort of planning really matters. So it's noting things like income over 100,000, you're going to start to lose some of your personal allowance. You've got the capital gains allowance, which is £3,000. You've got to think about marriage allowance. This is where spouse can transfer some of their unused allowances across. And you've also got things like the EIS, SEIS and VCT schemes.
I think, we've got child benefit in there as well, just to consider as well.
Yeah, and child benefit as well. So that tapers between 60 and 80,000. So if you're earning between that, you're probably going to have to start paying some of that back.
So if there's one message that hopefully you get from this, is that it's not just about ticking boxes. It's a really good time to seek out planning advice and to make sure that you get everything sorted before the end of the tax year approaches. Otherwise, it will be too late. Thanks for joining us. I hope that's helped make the tax year end a little less daunting and a bit more manageable.